Hi, everybody. Welcome to our DAT IQ weekly market update. This is our update for August 20. This is episode 305. I'm Dean Kirk, market analyst here at DAT, along with co-host Chad Kennedy and special guest all the way from Arizona, Cody Kaler. Welcome, Cody. Welcome, Chad.
Yeah, good morning.
Thanks for having me on.
It must be early out there.
Yeah.
Right, Cody?
Yeah, we start. We always work on East Coast time, so I'm usually up at about 4:30.
Okay, cool.
Got to get those emails going, buddy.
Yeah. How's the heat been out there this summer?
It's been terrible. We're over 100 days, over triple digits. So usually we get, a lot of people don't realize we have monsoon season during the summer out here, right? And you used to be able to set your watch by it like every night or every other night. Storms would start to roll in about 5 p.m., dump a bunch of rain for about 15 minutes, and then get out. But we haven't had hardly any of that. So we've been, 110 plus for, I think it was 80 plus days or something like that going on.
Right.
Wow.
Yeah, so it's been a little brutal this summer.
Yeah. How about you, Chad?
Yeah, it's been hot down here this summer in Florida. Very humid. And Hurricane Debbie brought through some humidity that's still hanging around. I know that made its way up the East Coast. And we dodged a bullet with Ernesto. I know, Dean, it kind of missed your area up there in the Boston area, but you're north of that this week, right?
Yeah, I was in Nova Scotia yesterday, and they were quite relieved that it decided to head out to the ocean after the bad experience they had with Fiona.
Yeah,
a few years ago, back in 2022. All right, Cody, tell us a bit about yourself for those that don't know you and what you do out there.
Sure. Yes, I'm the Senior Vice President of Sales and Marketing here at ANZ Trucking. We're a almost 25-year-old brokerage that specializes in reefer truckload and LTL, very heavy in the produce industry. So we're a 3PL, but we also own warehouses. We own warehouses in the produce hubs in Yuma, Arizona, Salinas, California, Wapato, Washington, and then hopefully in the next 2 years, Miami and McAllen. So we work with a lot of large, not just shippers, but growers to do a lot of their consolidation. Anybody who works produce knows that you tend to have a pretty high pick count on a lot of stuff, just because of, harvest challenges that happen every day, whether that's labor or weather conditions or whatever it is on the field. So, we do a lot of the ugly stuff. We work really heavy in food service too. So I think our highest pick count this year has been 12 for a load. So that's, we do a lot of what we always say, we do a lot of the hard shit that nobody else wants to do. So.
Right. Yeah. Generally some good opportunity there too, margin wise, right? When you take all that in.
Yeah. When you're able to do stuff that other people don't want to touch, you kind of get a good niche.
It's a good niche. Yeah.
Mm-hmm.
All right. We'll bring you back a little bit later, Cody. We'll dive into the market update. We'll get through that quickly. Remember, everyone, the long form version of today's market update will be published this evening at dat.com/market update. A couple of trends we're watching. Line haul rates softened a little bit last week, but along seasonal lines, there was a higher volume of loads moved, fewer load posts. So there's probably some high levels of routing guide compliance sitting in there. Jason Miller's truckload ton mile index came out for June. Demand is moving along the bottom of a trough, to use his words. No sign of a seasonal uptick. If you go to his LinkedIn profile, you'll see ton miles on the chart going back to 2013. The good news, even though volumes were down about 0.4% in June and 0.7% year over year, the good news, according to Jason, was it was one of the smallest negative seasonally adjusted year over year readings since the start of the current freight recession. Tim Denoyer pushed out the CAS report last week. He talked about a nice bounce after 4 months of sequential declines. The CAS index includes some LTL and intermodal. The CAS index turned upward in July, up about 3% from June. The Canadian rail strike's looming this week. I think it's Thursday. I spoke to a CN train locomotive engineer in Nova Scotia on the weekend. He operates trains up in the Maritimes. He said they're confident CN will cave in at the last minute, to quote him, and avert a lockout. So we'll see if that happens. It's the first time in 15 years CN engineers would go on strike if that's the case. All right, so let's dive into our market update. Start with our load to truck ratio. Following last week's 3% decrease, load post volumes were about 2% level than the long-term 7-year average. That's excluding the pandemic years. Capacity loosened slightly. There was a slight increase in the load to truck ratio. It ended the week at 3.84. In refrigerated, after being primarily flat for the last 4 weeks, reefer volume in load postings decreased by about 6% last week, about 21% lower than year over year. That'll be some discussion we'll have with Cody on produce season trends a little bit later in the show. Carry equipment posts about 5% lower, load to truck ratio down slightly to 6.13. And in flatbed, after decreasing for 4 weeks, flatbed load posts reversed course last week, up 8% week over week. They're sitting about 18% higher than this time last year. Equipment posts on the carrier side were down 7%. Last week's load to truck ratio up 16% to 10.68. Having a look at our year-over-year look at spot rates, after remaining mostly flat in recent weeks, dry van line haul rates decreased about half a penny per mile, not quite a full penny last week, down to about $1.62. It's about 3 cents a mile higher than last year. Looking at our top 50 lanes based on the volume of loads moved, they were down a penny per mile to $1.99 last week. That's about 37 cents a mile higher than the national average. In refrigerated, the national average reefer line haul rate was mostly flat, has been for the last month, even though load volumes that were up last week. At $1.97, reefer spot rates were identical to this time last year, and they're about 2 cents a mile lower than the 3-month trailing average. And lastly, in flatbed, the national volume of loads moved was up 5% last week, and it's about 7.5% higher than last year. But the market did find sufficient capacity to move the higher volume. Flatbed line haul rates were down 2 cents a mile to a national average of $1.97. As you can see on the chart there, they're about 4 cents a mile higher than last year, and 9 cents a mile higher than where they were in 2019. So let's have a look at our short-term forecast. These go out 35 days. There's about a 6 to 7 month view, as you see there. The blue line is the rolling 7-day weighted average for those new to the show. It's our moving average of historical rates of loads moved over 550 miles. So they exclude fuel, line haul only. Ratecast, which is in all of our products, is the green 35-day forecast. Red is the short-term model. It more heavily weights data seen more recently, and the yellow and grey are blends of the two. So let's start with the dry van. Fair bit of model disagreement here. That's been the case for the last 3 or 4 weeks. Ratecast is very optimistic that dry van rates are going to continue to climb. I don't see that. I think there's still sufficient capacity in the market with demand moving sideways to keep rates relatively flat. I'm more inclined to go with the yellow and grey blends in terms of model directionality. I think the red is probably a little bit more aggressive as we head into the peak shipping season in September and October. So I'm going with the middle point there. Refrigerated, strong model agreement that the rates are going to improve over the next 35 days. That's a very interesting trend there. But again, that's been what the models have been showing for the last 3 or 4 weeks. And lastly, in flatbed, we're seeing much the same thing. We've been seeing this downward trend for the last 6 weeks with the rates. I think Ratecast in green is the best guide for where we think rates are going to go. Chad, what are you seeing in your side of the market on the contract side?
Yep. So let's go over the spot premium ratio for dry van rates. So this is the difference between spot rates and contract rates. And all of these rates that I'll discuss here are from a shipper perspective. So everything Dean covered there was on a broker to carrier perspective. So we're seeing the spot premium ratio right now at negative 5%, kind of bouncing around this trough. We've been in this freight rate recession, if you will, since early 2022, and it's continuing to drag along. As this metric starts to tick up to 0% or above, that's a sign that we're starting to flip the market. Moving on to the new rate differential. This is the difference between the percentage difference between new rates entering shippers' routing guides and those old rates that are leaving. So we're at a negative 1%, continuing to bounce around this trough. So shippers are still getting rate reductions from bids. This might be a short-term seasonal bid, or it could be a long-term annual bid. And then finally, contract rates for dry van, we're seeing those pretty flat, kind of still continuing to drag along the bottom there. So let's jump over to reefer. Same story on all 3 metrics. We are seeing the spot premium ratio continuing to climb a little bit, but still at negative 5%. So those spot rates still lower than contract rates. We do see a tick down in the contract rate index there in purple. And we'll see if that trues up as we get more data in over the next week or so. And then finally, to wrap it up with flatbed, a lot of variability in that spot premium ratio, as you would expect, still in the negatives, and no sign of that climbing up anytime soon. New rate differential at -4%, and contract rates slight tick down. So continued softening in freight rates is what the shippers are seeing, Dean.
To get Cody's take on this, I mean, these are national average rates, and they don't necessarily reflect what you might be seeing on an individual lane. But I noticed, Chad, replacement rates in the reefer section were coming in 5.2% lower. They've been dropping quite consistently, in fact, all year. Do you still see a softening in rates on the reefer side more so than dry van continuing?
That's what the data is showing. We surveyed some shippers just last week, and we're getting kind of some mixed signals from shippers. What they in general are telling us is they are taking some rate increases on some lanes and continuing to get rate decreases on other lanes. So it's a little bit of a mixed bag. So it kind of supports this trough, or I don't know if you want to call it an equilibrium theory, but we're kind of dragging along this bottom.
Yeah, we are certainly dragging along. All right, let's bring Cody back in. Cody, let's start off with California. It's probably our biggest market at the moment. It's probably roughly 40% of the truckloads moved each week, according to the USDA. How's the California produce season shaping up as we head into this transition phase of the year?
It's actually been pretty soft. We did see some seasonality, which was good to see, right? You want to see that return to normal. So 4th of July peak, I think it peaked a little bit earlier this year, according to one of the episodes I saw you on. But we did see a little bit of seasonality return, not as steep as we've seen in the past, but definitely California's been down. And I'm not sure really why, outside of demand. From what I've heard from our customers, it's just demand's not quite there. I know that lettuce prices were the second highest they've been all time this summer. So I think a lot of that has to do with it. It's just everything's expensive out there. So I don't have any other. I know that the harvest wasn't bad. They didn't have any water issues this year. I think we're going to have some water issues in Yuma this season, though. But I don't think that California really had any excuse except for just demand has been pretty weak.
Yeah, I looked at. I always sort of leery of year-over-year comps after your advice a couple of years ago. So I went back and looked at all the way back to 2018. And when you look at the peak season out of California, the USDA data shows it's about 17% lower than last year's peak. When you go back all the way back to 2018, it's about 12% lower than the peak going back to 2018. When you think about the peak being in that early weeks of August is when shipping volumes start to peak out of California. So compared to prior years, it's way down. So that supports your comments there. One of the things we heard was it was extremely hot out there, and that was causing some issues with volumes. Is that what
it does? The issues that mostly causes is actually like harvest time. What a lot of people don't realize is, the majority of the produce is actually harvested the morning that it's shipped. Right, because every day that it's been picked, it's dying, so they lose shelf life on it. So if it's extremely warm in the mornings, they're only able to harvest for a couple hours. Especially when you're talking about like strawberries and stuff like that, right? Strawberries are super sensitive to heat, but that's really the major challenge that I've seen. And back to my comments about our monsoons over here, it's the same thing that California's been seeing. Is what we've been seeing is our daytime highs have been kind of like on par, but the problem is our nighttime lows. And California is seeing this, especially in Southern California, they're not where they should be. They're off by about 10, 15 degrees, right? And so when you don't have that reset in the middle of the night, it makes it very hard to harvest those crops in the morning. So just because there's supposed to be 100 truckloads that ship out that day, they might be only able to harvest 50 or 60 of those truckloads before the heat, really kicks in. So.
I didn't know that. That's very insightful. Appreciate that. Before we're talking off air, can you talk a little bit about the typical number of picks per load, like the number of loads, a number of individual load locations a driver might have to go to get a typical load of produce out of California?
Yeah. So our California is about, our average for this year has been 3.2 picks. So just a little over 3 picks out of California.
What drives that, Cody? So you're saying, so there's multiple stops on the pick side. Is that they're not filling up a full truckload at one stop, and is that because of how much they're picking at that location?
Yeah, and it's we have a produce wholesale company that's another branch of our company, and so their typical morning is they're going to call the big boys. I'm not going to mention their names on air, but they're going to call everybody, right? And they're basically checking what product do you have this morning? Romaine, iceberg, broccoli, everything else, and somebody might have had a better harvest in the morning than somebody else, and so typically they're buying from a couple locations just to fill the need. And those locations can change every single day. I mean, you can have, we do a lot of contracted freight with some of the larger shippers out there, and they basically have us bid by region because, it's not going to always be the same 3 picks every Tuesday. You can pretty much guarantee it's going to be 3 picks, but it might be, one shipper this week, another shipper the next week, and then you could buzz through 3 or 4 shippers in a single pick, and then not see those same shippers on your next week's load.
Wow.
So it all just depends on availability of product usually, and then pricing, of course. But
a lot of variability, a lot of short lead time. What is your average lead time by the time you are able to tell a carrier when to go pick up a load?
12 to 24 hours for produce. Mm-hmm. Yeah. So we'll typically get, so like today, Monday afternoon, we'll get our tenders for tomorrow.
Mm-hmm. Yep. So you pay a bit of a premium for that.
Yes. Yeah. It's, they have gotten better, over the years. I mean, I've seen a pretty big reduction in like same day loads. We've got a couple customers that have moved to giving us at least 48 hours, which is nice. Mm-hmm. But yeah, it's not like, we move other product outside of produce and you're getting 10 to 14 day lead time on some of that stuff. And produce is completely different. So there is definitely a premium, and it makes managing your carrier base a lot harder too.
Have to have a very high degree of reliability from those carriers, right? Do you ever over order capacity? Is that a thing?
Of course. Yeah. We there's definitely times during the summer where we have a lot more trucks every single morning than we have loads. And that's where my sales really has to kick it in the butt and go after some spot freight. But spot's been very non-existent the last 2 years. So
yeah. That makes sense. One of my first jobs in the trucking industry, I cut my teeth dispatching, and I had a tomato grower in Central Florida who would light me up if we weren't there on time in the morning. So I get a appreciation for the sensitivity to that.
Yep.
Cody, while we're talking about carriers, talk about some of the requirements you have for carriers in terms of the equipment and the just general service levels they provide.
Yeah. So typically, most customers are going to require like a 97 to 98% on-time delivery for produce, where industry standard for non-produce is kind of like 94 to 95. The reason for that is safety stock, right? Most warehouses aren't carrying a whole lot of safety stock for produce because it's the highest shrinked items in their warehouses. I'll go back to strawberries or cherries. Cherries are the worst, just in case anybody wants to get in produce. Cherries are very, very difficult, but they're typically only carrying like 10 to 24 hours of safety stock in there. So if a truck breaks down and you're not able to get it there on time or anything like that, they're basically losing sales for a full day. So produce is definitely different when it comes to the requirements. So for us, requirements, especially on the trailer side, that's where we focus more than on the tractor side. You're talking, we typically don't have any reefers older than 5 years old, outside of potatoes and onions, apples. Those loads aren't near as sensitive. But you're going to see, obviously reefer breakdowns happen more after about 5 years. And then on top of that, like the thermo efficiencies of the trailer itself starts to degrade after 5 years. So you see a lot more like, holes in the trailer, not necessarily holes, but just like, seals that aren't quite intact and all that stuff. So you lose airflow. So we're pretty strict on anything that's not the hardy stuff, which is onions, potatoes, and apples. Reefer's got to be at least, 1 to 5 years old. Typically we're going to look at, tractors, not as heavy, but we also don't want tractors over about 10 years old unless they've been rebuilt and we can see all that fun stuff. But we're pretty consistent. Like I said, we've been doing produce for almost 25 years. So we're pretty consistent with our carrier group. We work with our carrier reutilization is pretty high compared to our peers. So we're constantly making sure that all of our carriers are in line with that stuff. But that's a big requirement for every single one of our, cherries and berries, especially. We actually try not to go over 2 years on the reefer. just because those are so sensitive. And they're also, you're talking a full load of organic strawberries, for example, is about $200,000 worth of freight. Cherries this year, we saw a couple that were $250,000, value. So you definitely don't want to throw an older trailer on that.
Right.
There's too much risk in that.
Yeah.
What about, do you have certain carriers though that stick to certain commodities? Like, do you always load the same guys with a certain freight?
Yep, we have our cherry carriers, like literally, and when we run out of those guys each day, I basically have to tell my customers can't take any more cherry loads, just because they have the proper insurance, they have the proper equipment, but also like we trust those guys. They know how to run those. Cherries are super. Not only are they sensitive, but they're kind of a pain in the butt to load, because up in Washington, we talked about the number of picks down in California. But Washington, like, you may have a shed that you're supposed to go pick up from, but that shed is actually getting it from like 5 or 6 different orchards, right? And sometimes if they have a breakdown on their transfer trucks or they didn't have a driver show up or something, that one pick can turn into 4 or 5. And cherries are the same way. Like they kind of start to deteriorate and melt if it's too hot. So they've got to get it from picked to cooler within about 2 hours. And so, we run into a lot of 1, 2, 3 day delays on cherry loads, and you got to have the right carrier for that. If they haven't ran, cherries before, they're going to drop off your load, or they're going to leave you the worst review you can ever think of. They're going to hate you guys. So we tend to stick to the more sensitive product, has the same carriers on them.
Yeah. With the perishable nature of this product, do you utilize a lot of teams?
Oh, absolutely. Yeah. Anything going probably past Chicago, we get teams on. Yeah. And then since we have our own warehouses as well, we tend to add like 2 or 3 extra temp tails, Sensitex, the trackers, so that if anything happens in transit, we can catch it before it actually gets to the destination. That's pretty pivotal when it comes to your high dollar produce, your cherries, your berries, all that fun stuff.
Cody, before we Chad asked a great question before we started. When the market transitions from Salinas for leafy greens to Humor, does the capacity migrate also, or is it different capacity that comes from down there?
A large portion of it does actually migrate down there. We have dedicated fleets that run for us. Like, for example, our local guys that they basically go do all of our local picks and bring them back to our warehouses so we can get the outbound trucks out. They transition with us, and a lot of the same carriers that we use for Salinas will transfer, 50 to 60% of their fleet down to Yuma. Yuma season's never really as large as Salinas season, right? Volume wise. So, but you're going to see a large portion of the same carriers.
Do you find a lot of carriers will deadhead out of Phoenix, for example, or would they deadhead out of Ontario?
Yeah. Phoenix, we consume a lot down here, but we don't produce a lot when it's off season. So Phoenix is kind of the hub during the winter because you got Nogales that starts as well during late winter, and then Yuma starts October, November. So anybody landing in Phoenix is probably going to end up, if you got a reefer, you're probably going to grab some high paying produce load during the winter.
Mm-hmm.
Right. When I look at USDA data, they talk about truck availability every week, and they rank it between 1 and 5. During the worst of the pandemic, it was like 4.5, very tight capacity. It's been about 3, which is kind of, in their world, an adequate supply of trucks across every market except eastern Indiana, where there's watermelons at the moment. But I think that capacity will start to loosen once that season ends. So for the most part, there's plenty of capacity in the market. Is that how you see it regionally?
Yeah, we definitely, California it did have that return to seasonality, like I'd mentioned earlier, but it was still pretty soft this year. We are starting to see a little bit of tightening up in the Pacific Northwest. It's a little early for that. That typically doesn't happen until September-ish. And then obviously, I've talked about it several times, Dean, it goes crazy during the winter. But we are starting to see it tighten up there for sure. California's been pretty loose though for the most of the summer. Florida season was pretty much non-existent in my opinion this year. We didn't really see too much crunch there. Texas has been pretty good. The only caveat during the winter that a lot of people forget about is just all of the reefers come in east to west, especially out of the Midwest, when the freeze protection kicks in October. So you get a lot of, the one that always pops into my mind is like Procter & Gamble. They have a huge plant in Illinois. All the tide and all that fun stuff that runs on dry vans during the summer, that all has to go on reefers with 65 degrees during the winter. That causes a tightening of capacity from the East Coast heading west. So you always have this shift during the summer, right? It's hard to get reefers from the West Coast to go east. And then during the winter, you see the exact opposite. And that's one of the main reasons.
Right. And then you get to the Pacific Northwest and you've got fall produce competing with Christmas trees.
Yep. Yeah, you get that first apple harvest. You get the new crop of potatoes coming out of Idaho and Oregon. And then you got, gangbuster on the Christmas trees. So it's you have about 3 months of not fun capacity in the Pacific Northwest, to put it nicely.
Yeah, this is fascinating. I've actually learned some new things today. It's always good to have you on the show, Cody. Yeah. Anything else that you want to share before we wrap up today's episode?
No, just, like I mentioned earlier about Yuma, the biggest thing that we're watching right now is just the water. We hit, I got a text about a month ago on my phone that we had hit level 2 on our drought warning. That hasn't happened to me. I've been here 8 years. That hasn't happened in 4 years. So I tried to do all my research on seeing where the water levels were at before this episode, and I couldn't find anything published yet, but that's the big thing to watch for Yuma season.
Right. Okay. All right. Quick shout outs on the Freightvine podcast that's out this week. Professor Kaplis is talking to Josh Brogan about the Kearney State of Logistics Report. DATCon is coming up at Kansas City, October 22. Don't forget to register. Go to dat.com/DATCon. Use code update100. I'll be on with Jimmy Mack on Radio Nemo, channel 146 on Sirius XM this Thursday. Next week's show, we've got an owner-operator, Corey Larson, is talking about life on the road. Cody, before we wrap up, how can people get in contact with you?
LinkedIn's the best way to get in contact with me. If not, just hit up our website, amztrucking.com.
Okay. All right. Everyone, don't forget Brake Check Week is next week. The CVSA Brake Check is on. I think it starts this coming Sunday. Make sure you sign up for alerts to our show and subscribe to the channel. And with that, another show is in the books. Be safe, be nice to everyone, and we'll see you again next week at 10 a.m. Eastern, 7 a.m. Pacific.